Hello, and welcome back to the MSA channel. I'm Peggy from the Corporate Services team at MSA. At MSA, we specialize in guiding international businesses through the complexities of expanding into key Asian markets, with a particular focus on China. Our expertise ensures smooth and compliant market entry for our clients. Today, we'll be talking about company liquidation in China. If you're considering closing your operations, understanding this process is essential. Liquidation is not just about shutting down your business. It's about properly deregistering your entity with the authorities, settling all obligations, and protecting your company's reputation. So, let's dive into what you need to know. Liquidation in China is the formal process of deregistering a business with the relevant authorities. This applies whether you're operating a wholly foreign-owned enterprise, a joint venture, or any other type of entity. While it may sound straightforward, the reality is that liquidation in China is highly regulated and involves multiple steps, approvals, and audits. On average, the process can take 12 months or more, depending on the company's size, activities, and compliance status. Now, let's talk about why companies liquidate. According to the company law of the People's Republic of China, there are several statutory grounds that require a company to dissolve when the company's term of operation as specified in its Articles of Association expires, when stakeholders pass a resolution to dissolve the company. In a case of a merger or division, if the business license is revoked or operations are ordered to cease, and when a court orders dissolution. Beyond these formal triggers, many companies also liquidate due to changing strategies, rising costs, or restructuring. Before starting the liquidation process, there are several important points to prepare for. One of the biggest factors is handling your employees. Chinese labor law is rather protective of workers, which means you need to settle all employment contracts and severance agreements before moving forward. You'll also need to make sure there are no outstanding legal disputes because ongoing litigation can put the entire process on hold. Another critical point is compliance. All tax filings, audits, and publication reports must be fully up to date. Otherwise, deregistration approvals can be delayed significantly. And finally, you must maintain a valid registered business address until your company is fully deregistered, which often means continuing to pay rent even if your office is no longer operational. Once the decision to liquidate has been made, the process begins with forming a liquidation committee within 15 days. This committee is usually composed of company representatives, legal advisors, and accountants, and it manages the entire process from start to finish. After the committee is set up, an online announcement must be filed within 60 days. This announcement informs creditors and gives them 45 days to declare any claims. During this period, the committee reviews company assets, prepares a balance sheet, and manages settlements with employees, suppliers, and other stakeholders. Once all claims are identified, the committee begins selling company assets, such as machinery, intellectual property, or other holdings. The proceeds are used to pay liquidation expenses, employee settlements, taxes, and outstanding debts, in that order. The next step is obtaining clearance from the tax bureau. Because liquidation reduces future tax revenue, tax offices often review filings closely and usually require a full audit report for the past 3 years. Only after receiving tax clearance can the process move forward. After tax clearance, you must submit all your final documents to the state administration for market regulation. Once the AMR approves the deregistration, the company is officially dissolved. At this stage, all company bank accounts are closed and the company shops are destroyed. From that moment, the company legally ceases to exist. One final note: even after deregistration, Chinese law requires you to keep all accounting books, vouchers, financial statements, tax payment records, invoices, and exportation vouchers for 10 years. Most liquidated companies courier these records back to their parent group abroad for safekeeping. It's also important to understand the difference between liquidation and bankruptcy. In liquidation, you remain in control of the process and can negotiate directly with employees, suppliers, and creditors. In bankruptcy, however, a court-appointed committee takes over entirely. You lose control over decisions like asset sales and debt settlements, and the process can become more complicated and less predictable. Whenever possible, the best option is pursuing a controlled liquidation, as it will minimize risk and protect your company's reputation. Liquidation in China can seem overwhelming, but you don't have to navigate it alone. At MSA Advisory, we've guided countless enterprises through this process smoothly and efficiently. Our team ensures compliance at every step, from employee settlements to tax clearance and final deregistration. If you're considering closing your operations in China, visit our website or contact us directly for personalized support tailored to your business needs. Thank you for watching, and don't forget to subscribe to our channel for more insights on doing business in China.